Thanks for tuning into this video from Openstax Chapter 17, Finance, How Firms Raise Capital. Be sure to like and subscribe. A firm has to make choices about how to fund its operations on a permanent basis. This comes down to a decision on its capital structure, specifically how much debt it should employ as compared to equity. Capital is composed of the two principal sources of funding for a firm's operations: debt, which are liabilities or amounts due to creditors, and equity, funding provided to the company by its owners. Equity is more at risk than debt, as debt has priority in getting paid back, but there is limitless upside for an equity investment. Debt and equity holders expect to be compensated for their capital contributions to a firm. Their funding comes with the cost of the firm. A firm must offer competitive rates of return to both debt holders and equity holders in order to obtain the capital it needs, so a firm's investment should earn at least as much as the cost of obtaining its capital. Debt and equity holders expect to be compensated for their capital contributions to a firm. Alternative investments compete for capital, so a firm must offer competitive rates of return in order to obtain the capital it needs. There's an opportunity cost consideration at work here. The opportunity cost of funding a particular firm is what I am foregoing for not funding the next best alternative investment. Funding is not cost-free, and therefore this cost must be factored into a firm's investment decisions. A firm's investment should earn at least as much as the cost of obtaining its capital. In evaluating a firm's cost of capital, the proportions of debt and equity to total capital are an important input. The market value of the firm is equal to the market value of the debt plus the market value of the equity. Note that market values are used and not book values. Book values represent what the accounting financial statements carry debt and equity at, but these values are not representative of the firm's market values for debt and for equity. A public firm's debt is traded in financial markets, and its market value can be determined from market data. Its equity will also be traded in financial markets, and its market value can also be determined from market quotes. The weights are calculated as follows. The weight of the debt is equal to the market value of debt divided by the market value of the firm. The weight of equity is equal to the market value of equity divided by the market value of the firm. The result of this calculation will be in percentages of the total market value of a firm. The percentage weight of debt plus the percentage weight of equity will always be equal to 100%. A firm's cost of debt is the interest rate it must pay to obtain debt funding. For companies with public debt, this can be determined by calculating the current yield to maturity on this debt. Interest on debt is tax deductible, meaning it reduces a firm's income tax liability to the tune of the marginal corporate income tax rate times the interest expense. The after-tax cost of debt is calculated as the return on debt times 1 minus the tax rate. The after-tax cost of debt is the pre-tax cost of debt multiplied by 1 minus the income tax rate. Whereas debt holders charge borrowers the pre-tax or nominal cost of debt, a firm's after-tax cost of debt is lower because interest expense is tax deductible. Equity holders, the owners of the firm, expect to be compensated for the risk that they take on in making their investment. The most objective way to determine the cost of equity is via the capital asset pricing model, or CAPM, which is expressed as the return on equity equals the risk-free rate plus equity beta times market risk premium. The risk-free rate is the rate of return offered by long-term U.S. government securities. Beta is a measurement of the responsiveness of changes in the firm's rate of return with respect to changes in the market's rate of return. By definition, the market has a beta of 1, and the market's overall return is what you would expect to make from an investment in an average stock. The weighted average cost of capital, or WACC, is the minimum required rate of return a firm must make on its investments to cover its cost of obtaining funding. The formula for weighted average cost of capital is the debt percentage times return on debt times 1 minus the tax rate plus the equity percentage times the return on equity. D% and E% represent the weight of debt and common equity, respectively, in the capital structure. The after-tax cost of debt is RD times 1 minus T. The cost of common stock capital is represented by R sub E. The cost of debt multiplied by 1 minus the tax rate is the after-tax cost of debt. The weights of debt and equity are the proportions to total capital. The cost of equity is the firm's cost of obtaining equity funding. There is a tendency to use historical data as inputs for this model, but there is no assurance that history will repeat itself. Determining cost of equity is less a science than it is an art form. Some analysts use net debt rather than gross debt in determining the weight of debt to total capital. The argument is that a firm is in a position to use its liquid assets to pay off debt, and that therefore its gross debt is not a true indication of how much debt it actually shoulders. In this case, cash and cash equivalents will be deducted from the market value of debt before the calculation for the weight of debt is performed. In deciding how to fund a firm's operations, one can fund it entirely with equity, entirely with debt, or some combination in between. A firm that is 100% funded by equity has only what is called business risk, risks that all businesses are exposed to, such as economic fluctuations, competitive pressure, and the like. As a firm takes on debt, it takes on financial risk as well, the risk that it may not meet its financial obligations as they come due. The more debt a firm takes on, the higher the level of financial risk it is exposed to. This additional risk is the impact of leverage. Whereas firms tend to think that taking on more debt will lower their cost of capital, the cost of debt and the cost of equity are not fixed and will change as their capital structures are altered. If the cost of debt and of equity are fixed, then taking on more debt would result in a lower weighted average cost of capital, as you would be diluting the more expensive cost of equity with cheaper debt. However, taking on more debt tends to raise the cost of debt, as lenders will demand higher compensation for the additional financial risk the debt creates. And as the firm employs more leverage, its cost of equity will also rise. So the employment of more debt will cause the cost of both debt and equity to rise, which will result in the value of a firm possibly remaining unchanged. Interest on debt is tax deductible, meaning it reduces a firm's income tax liability to the tune of the marginal corporate income tax rate times the interest expense. The after-tax cost of debt is equal to the pre-tax cost of debt times 1 minus the income tax rate. In dollar terms, the interest tax shield is calculated as the interest expense times the corporate tax rate. Because interest expense is tax deductible and gives rise to a tax shield or tax benefit, the use of leverage has an impact on the firm's value. Because interest expense is tax deductible and gives rise to a tax shield or tax benefit, the use of leverage has an impact on a firm's value. Debt typically is cheaper than equity, as it is, after all, less risky than equity and additionally benefits from tax deductibility. There is a natural tendency for firms to want to use debt financing in their capital structures. But a word of caution is necessary at this point. Taking more debt will result in lenders demanding more interest to compensate for the additional financial risk, and not only that, equity holders will also want compensation for the incremental financial risk. So taking on more leverage is not necessarily productive. Risk for firms has two components, business risk and financial risk. Business risk is made up of normal risk for a business, such as the economic environment and competitive pressure. Unlevered firms, or firms that don't have any debt, have only business risk. As a firm takes on more debt, it exposes itself to financial risk. The cost of debt rises as debt holders will demand more compensation for financial risk. The cost of equity also rises as higher borrowings layer on financial risk to a firm's business risk. As the firm transitions from having no debt to taking on more debt, the weighted average cost of capital at first declines and hits a minimum. But as the cost of debt and of equity rise, the weighted average cost of capital also starts to rise. As the firm takes on more debt, the cost of debt rises as debt holders demand more compensation for financial risk. The cost of equity also rises as higher borrowings layer on financial risk to a firm's business risk. As a firm transitions from having no debt to taking on more debt, the WACC at first declines and hits a minimum. But as the cost of debt and of equity rise, the WACC also starts to rise. There's a certain amount of debt that one can characterize as optimal. This is at the point where the WACC is at its lowest point. A firm wants to minimize its WACC. Taking the WACC down to a minimum raises the value of the firm. However, coming to the decision as to the optimal level of debt it should employ requires that it weighs certain trade-offs. Higher debt results in a larger tax shield. However, higher debt also results in increasing financial risk. As leverage is taken on, the WACC will drop at first and then rise if the level of debt surpasses a certain level. The determination of when exactly the WACC will start to rise is more of an art than a science. There is a certain amount of debt that one can characterize as optimal. This is at the point where the WACC is at its lowest point. Taking the WACC down to a minimum raises the value of the firm. However, coming to the decision as to the optimal level of debt a firm should employ requires that it weighs trade-offs. Higher debt results in a larger tax shield. However, higher debt also results in increasing financial risk. As leverage is taken on, the WACC will drop at first and then rise if the level of debt surpasses a certain level. The determination of when exactly the WACC will start to rise is more of an art form than a science. Preferred shareholders hold securities that have features that look like debt and also like equity. Preferred stock is preferred with respect to dividends, as common shareholders cannot get a dividend distribution unless preferred shareholders are paid first. Preferred stock usually comes with a fixed coupon payment that looks similar to the interest due on debt but is usually lower. Preferred stock is slightly riskier than debt but less risky than common stock. Preferred stockholders cannot vote their shares as common shareholders can. They aren't full owners of the firm in the sense. The cost of preferred is the preferred dividend payment divided by the preferred share price. When a firm also has outstanding preferred shares, the WACC formula needs to be adjusted. The original formula for WACC is WACC equals D percentage times RD times 1 minus T plus 8% times RE. When preferred stock is present in the capital structure, the WACC becomes D% times RD1 minus T plus P% times RPFD plus E% times RE. P% represents preferred stock in the capital structure. Note that D% plus P% plus E% must equal 100% because the company must account for 100% of its financing. The cost of preferred stock capital is represented by RPFD, and the cost of common stock capital is represented by RE. Preferred dividends are not tax deductible, just as common stock dividends are not tax deductible. So there is no adjustment for an after-tax cost preferred. When a firm contemplates raising equity via a new stock issue, it must adjust its costs of equity for flotation costs. Flotation costs include filing fees with the SEC and investment banking fees to place the new issues. In this case, the gross proceeds from the new stock issue needs to be reduced by these flotation costs, as only the net amount raised matters. Sometimes debt is issued with a convertible feature, a provision allowing bondholders the option to convert their bonds into a fixed number of common shares. Bondholders can therefore enjoy the safety of contractually obligated interest payments while potentially being able to participate in the value created by the firm for its common shareholders should the firm do well. The bondholder can decide if and when the convertibility option is exercised.